Welcome to Iron Financial. This is the place where we forge a stronger portfolio by putting the market's biggest stories under the microscope. I'm your lead analyst. All right, let's get right into it. ADT's latest earnings report has hit the street and it has thrown the market into total confusion. It's a real battlefield of signals out there. You've got the bullhorns blaring on one side, you've got the bear growls on the other. Our mission today is to cut right through all of that noise. We're going to deconstruct this company's financials, piece by piece, bolt by bolt, and figure out if it's a solid fortress for your capital or just a pretty facade that's about to crumble. And I'm your market skeptic. Let's start with the thing that's causing all this chaos in the first place, because it really makes no sense. How can a company have an amazing quarter and a terrible quarter at the exact same time? Just look at these headlines on your screen. The bulls are celebrating, right? ADT beats estimates. That sounds great, a clear win. But literally right next to it, the bears are growling. ADT Inc. profit drops. So which one is it? Did they win or did they lose? It's impossible for both to be the real story. When you see a contradiction this stark, this blatant, right from the get-go, it tells you something critical is happening beneath the surface. One of these headlines is the narrative management wants you to believe, and the other might just be the cold, hard reality they can't hide. So how is any investor supposed to build a solid thesis when the basic facts seem to be at war with each other?
That is the million-dollar question, isn't it? And it's exactly what we're here to figure out. We're not going to skim headlines, we are going to go deep. We're going to put ADT's financials on the anvil, and we're going to hammer away. We will meticulously examine every single load-bearing column of the bull case, and then we're going to take out our magnifying glass and search for every single foundational crack in the bear case. We're going to stress test this whole structure until we know exactly what it's made of. Let's get into it.
Okay, here's our blueprint for the day, our game plan. First, we're going to dig into these conflicting signals, because it's worse than you think. Then we're going to build the bull case from the ground up, looking at the numbers that suggest this company is on solid footing. After that, I'll hand the hammer over to our skeptic to find all the foundational cracks. Then we'll look at their plan for the future, see if it's a real rebuild or just some paint. And finally, we will deliver the iron financial verdict. Is ADT a fortress or is it a facade? Let's get to work. Right, and like I said, this isn't just a simple case of media spin. The problem here goes way, way deeper. It goes right down to the raw data, the numbers themselves that are being reported across major financial news outlets. You look at one site, you get one number. You look at another, you get a completely different number. When the very source code of your analysis is misjumbled, you can't build anything. You first have to clean up the mess and find a single source of truth.
And just look at this slide. This is pure chaos. We're not talking about a little rounding error here and there. This is a fundamental breakdown in how financial information is being communicated. Take a look at the reported Q4 revenue numbers. MarketBeat says $2.55 billion. But FinViz and ADT's own press release say it's around $1.28 billion. And the NASDAQ is even lower, down at $1.08 billion. The gap between the highest number and the lowest is over $1.4 billion. That is more money than the entire market cap of some companies. How on earth can a company's revenue, one of the most basic, essential metrics there is, be reported with this kind of insane variance? This is a huge red flag. It forces us to ignore everyone else and go straight to the horse's mouth. So for our analysis today, we're only going to use the numbers from ADT's official Globe Newswire press release. That's the $1.276 billion figure.
All right, enough of the chaos. Now that we have our single source of truth, let's build the bull case. Because despite all that noise and all that data confusion, there is a very strong argument to be made that ADT is in fact standing on solid ground. And this case isn't built on flimsy headlines or questionable data. It's constructed with hard, load-bearing numbers pulled directly from the company's official report. These are the metrics that Wall Street really cares about, and they tell a story of operational strength and very savvy management.
So the first pillar of the ADT fortress is right here, 23 cents. That's their adjusted earnings per share for the fourth quarter. Now, Wall Street analysts, the consensus, they were expecting 20 cents. ADT didn't just meet that number, they sailed right past it. They beat it by 3 cents. That's a 15% beat. In the world of quarterly earnings reports, that is a big, decisive victory. It tells you management is running a tight ship, they're controlling costs, and they are delivering profit on the one metric that all the algorithms and big trading desks watch the closest. This is the number that triggers the buy orders. It is a foundational win, plain and simple.
And look, that big quarterly beat, it wasn't some fluke, it wasn't an anomaly, it was really the capstone on what was a very strong year. For the entire fiscal year, ADT delivered 19% growth in adjusted earnings per share. Let that sink in, 19%. That's not the sign of a company that's just treading water. That's a company that is getting more and more efficient at turning its operations into bottom-line profit for its shareholders. This shows a clear, powerful trend of strengthening profitability.
It's a heck of an argument that the company's core earnings engine is running stronger than ever. Now, we get to my favorite metric, the lifeblood of any business, cash. Just look at this number, $863 million in adjusted free cash flow for the year. That's a huge number on its own. But what's even more important is that it's up 16% from the year before. And here's the key. Cash flow is reality. You can play all sorts of games with accounting and adjusted earnings, but you cannot fake cash in the bank. This tells us that the business is a cash-generating machine. This is the money they can use to pay down debt, to invest in new tech, and, as we're about to see, to return directly to the people who own the company. Robust, growing free cash flow, that is the sign of a healthy, durable business that can weather any economic storm. So, what does a company do when it has that kind of confidence and it's sitting on a mountain of cash? It does this. It authorizes a jaw-dropping $1.5 billion share buyback program. This is management looking at its own stock price on the open market and screaming, "It is too cheap." They're telling you that the single best investment they can possibly make with their money is in themselves. This isn't just some financial trick. It is a powerful, powerful signal of conviction from the people who know the business inside and out. They are committing to returning a massive amount of capital to shareholders, which helps support the stock price and rewards anyone with the patience to hold on. And to put the final stone on this bull case, let's look at the words from the CEO himself, Jim DeVries. Solid financial performance, robust cash flow, strengthening our financial foundation. The narrative coming straight from the corner office lines up perfectly with the numbers we just walked through. The official story is one of a company that's financially sound, that's growing its earnings, growing its cash, and confidently giving that capital back to its owners. From this angle, ADT looks like a well-built fortress, totally prepared to defend shareholder value. Okay, hold on. A fortress? That is a very strong word. Look, the analyst has laid out a nice-looking blueprint, I'll give him that. On the surface, it all looks clean, solid, I'll even say impressive. But our job here at Iron Financial is to be the inspector. It's to go up to those walls and tap on them and check for the cracks in the facade. And when you start stress testing these numbers, boy, you find some serious worrying problems. The entire bull case is built on a very convenient word, adjusted. So let's talk about the difference between the nice story they're telling and the actual reality of the numbers. Let's start right here. This single slide explains those two warring headlines we saw at the very beginning. Over on the right, you have the adjusted profit. That's the story. It shows they're up $10 million. And that's the number that gets you the shiny beats estimates headline. But now look to the left. Look at the GAAP profit. That's the reality. That's the number bound by the strict official rules of accounting. It was $146 million. A year ago, it was $197 million. That is a drop of $51 million. So while they are telling you a story about a $10 million gain, the reality is a $51 million loss in profit. That is not a small difference. That is a major foundational crack. And hey, while we're talking about reality, let's look at the top line. The bull case was celebrating that adjusted EPS beat, but they kind of brushed right past the revenue miss. The analysts expected $1.29 billion in sales for the quarter. The company only delivered $1.28 billion. Now, you might think, oh, it's only $10 million, but a revenue miss is a big deal. It signals a potential problem with demand for their products. See, you can always cut costs or use accounting tricks to engineer an earnings beat, but you can't fake revenue. It means they sold less stuff than Wall Street thought they would. That's another crack, this time in the growth story. And that little crack in quarterly revenue, well, it turns into a giant, gaping hole when you zoom out. Look at this. 5 years ago, ADT's annual revenue was $5.1 billion. Today, after 5 full years of work, acquisitions, new strategies, you name it, their trailing 12-month revenue is $5.13 billion. That is effectively zero growth. It's a flat line. A company that cannot grow its top line over a 5-year stretch is stagnating. It's stuck in the mud. How can you possibly call this thing a fortress when the whole building hasn't gotten any bigger in half a decade? It makes you seriously question the long-term viability of this thing as a growth investment. And now, we come to the biggest structural weakness of them all. This is the incredible weight that is pressing down on this entire stagnating structure. A debt-to-equity ratio of 1.99. Let's just call it 2, shall we? This means that for every single dollar of shareholder equity in this company, the part the owners actually own, there are $2 of debt piled right on top of it. That is a heavy, dangerous, precarious debt load. All that wonderful cash flow the analyst was so excited about, a huge chunk of it has to go right out the door just to pay the interest on this mountain of debt.
it limits their flexibility, it magnifies every risk, and if the economy turns south, this debt could become a wrecking ball. This isn't just a crack. This is a compromised foundation. Okay, the Skeptic has pointed out some very serious structural risks: stagnant revenue, falling gap profits, and a really heavy debt load. Those are legitimate concerns. You can't just brush them aside. But even a house with a shaky foundation can be saved, right? If you bring in a smart architect and a good crew. So the question now becomes, is ADT's new strategy a legitimate plan to rebuild and modernize this company for the future? Or is it just a cosmetic patch-up job designed to distract everybody from the real problems? Let's take a look at the blueprint. Here are the new materials management is bringing to the construction site. First up, the ADT Plus platform. This is their move to finally integrate modern smart home devices, things like Google Nest and Yale locks, into their professional security system. To be honest, this is just table stakes in 2025. Second, they bought a company called Origin AI, a move to bring some really cutting-edge tech in-house. And third, they're rolling out new safety features in their app to extend security beyond just your front door. On paper, this is absolutely the right strategy. It's a plan to pivot from being an old-school alarm company into a modern, tech-forward, smart home intelligence company. Let's focus for a second on that Origin AI acquisition, because this is probably the most interesting part of the entire rebuild. They're adding a technology called ambient sensing. So what it does is it uses the Wi-Fi signals that are already bouncing around your house to detect motion and presence without using any cameras. Now think about that for a second. This is a huge deal for privacy. It could open up entirely new ways to use security, like monitoring an elderly parent without making them feel like they're being spied on, or confirming a room is empty without needing a camera. This is a genuine technological innovation, and it could be a massive differentiator for ADT if, and it's a big if, they can execute on it. And this right here is the goal of that new blueprint. This is what management is promising this whole renovation project will deliver over the long haul. 5% annual revenue growth, which would finally break them out of that 5-year stagnation. 10% annual growth in adjusted earnings, and more than 10% annual growth in that all-important adjusted free cash flow. They're also saying they'll get that leverage ratio down. Look, this is an ambitious plan, but it's a clear one. It's management's promise to investors that their new tech strategy is going to build real, sustainable shareholder value over the next several years. Yeah, that multi-year plan is a beautiful architectural rendering of a skyscraper. It's exactly what you want to hear. But this slide, this is the building permit they just pulled for next year. And it's for a tiny single-story bungalow. After all that grand talk about growth and technology and compounded returns, the immediate outlook for 2026 is, and I quote, approximately flat. Flat revenue and flat adjusted EPS. So, after buying new tech and launching new platforms, the immediate impact on the actual business is nothing? This creates a massive disconnect. They are selling investors a dream of a bright future while delivering a reality of more stagnation right now. It makes you ask the question, if the new blueprint is so fantastic, why aren't we seeing any results next year? And that brings us right here to the final inspection. We've laid out the bull case, built on the strength of adjusted earnings and impressive cash flow. The Skeptic has hammered on the bear case, exposing the dropping gap profits, the stagnant revenue, and that heavy debt load. We've reviewed the blueprint for a modern rebuild, and we've contrasted it with a flat outlook for the year ahead. So now it's time. Let's synthesize all of this evidence and deliver the final iron financial verdict on ADT's financial structure. So it all comes down to this, the two sides of the coin. The fortress argument is powerful. You can't deny it. Adjusted EPS is growing, the company generates a ton of free cash, and they're using that cash to reward shareholders through massive buybacks. And their tech strategy, at least, is looking toward the future. But the facade argument is just as strong. That fortress has a cracked foundation. The real gap profits are falling. The company has literally not grown its sales in 5 years. And that debt load is like a wrecking ball hanging over the whole structure. And to top it all off, they're telling us to expect more of the same stagnation next year. It's the story of a company that might be past its prime, using financial engineering to wallpaper over a deteriorating core business. So what is our final verdict here? At the end of the day, ADT is a classic value versus trap dilemma. On one hand, the company is an undeniable cash cow. Management is pulling the right levers with buybacks to return that cash to shareholders, and that should provide some kind of a floor under the stock price. However, the lack of top-line revenue growth is a critical, glaring weakness. A business that isn't growing is slowly but surely dying. The new technology is promising, for sure, but that flat 2026 outlook tells you it's not going to be a miracle cure anytime soon. So the ultimate question for you as the investor is this. Is ADT using its immense cash flow and its new tech to truly build a modern fortress, one that's capable of real, future growth? Or is it just using that cash to slap a new coat of paint on a crumbling facade, a structure that is ultimately being weighed down by a mountain of debt and a core business that has simply stopped growing? The answer to that question will determine whether this is a solid foundation for your portfolio or a structure that is one bad quarter away from collapsing under its own weight. At Iron Financial, we stress test a market so you don't have to. Thanks for watching.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.